We all do the exact same math every day. We trade our strictly finite lifespan, hours, weeks, years, for tiny pieces of paper or digits on a screen. We make this trade because we assume those digits have a physical, static reality. But if you look past the history and the daily habits, a dollar bill is just a blend of cotton and linen. The only reason that paper buys a cup of coffee, while a stick from the woods does not, is that we have collectively agreed to trust it. This agreement goes back thousands of years. Gold is a shiny yellow rock. It isn't inherently useful for survival, but human perception historically decided it was rare and desirable, so it became the standard for wealth. Modern digital currency relies on that exact same mechanism. A Bitcoin has no physical form, yet it holds value because millions of people share a belief in the ledger that tracks it. If money is a psychological agreement, its acquisition is a reflection of utility. It functions as a receipt, a token society hands you for providing something of high perceived value to other people. When Steve Jobs unveiled the iPhone in 2007, he introduced a tool that millions perceived as highly valuable for their communication and status. People traded thousands of their earned dollars for that specific value, resulting in a massive transfer of wealth for a single idea. Shifting focus from the physical paper to this invisible metric of value is a prerequisite for understanding the rest of the system. It marks the transition from purely trading hours for cash to seeing how the machinery of wealth actually functions. The moment you earn that money, the system extracts its mandatory subscription fee, taxes. These deductions pay for the baseline infrastructure of your life, paved roads, public schools, and safety nets like Social Security that you get paid back when you eventually retire. Post-tax money usually goes into a bank. Most of us picture this place as a static vault where our cash is guarded. In reality, that money is often gone before you even leave the building. Banks operate on fractional reserve banking. As this diagram shows, the bank matches your cash with someone else's demand. You deposit $1,000, and the bank immediately lends out up to $900 of it to fund someone else's jet ski or car loan. This system only functions if everyone doesn't show up at once asking to withdraw. In 2008, when depositors lined up to pull their money out all at once, the lack of cash on hand caused the entire financial structure to fracture. The banking system functions as a perpetual motion machine of leverage. Your idle cash is already out in the world, working for someone else's profit. The incentive driving that machine is interest. You can think of interest as the rent charged for money existing in someone else's hands. There is a sharp contrast between simple interest, a flat fee, and compound interest. In compounding, every dollar of rent you earn creates clones of itself, and those clones immediately begin demanding their own rent. When you miss a payment on a high-interest credit card, this math turns against you. It turns a small mistake into a financial fire that consumes your income faster than you can earn it. While interest drives the engine, inflation acts as the surrounding weather. It is the slow, invisible erosion of what your money can buy over time. Inflation is triggered when too much cash chases too few goods, or when supply chain bottlenecks make producing those goods more expensive. Either way, your $5 bill buys less gas and fewer groceries than it did a year ago. The government fights back by raising interest rates. This makes borrowing painful and spending expensive, which reduces the amount of cash circulating through the economy. This cooling process often triggers a recession. It's a painful reset, where jobs vanish and spending stops. But it is a predictable part of the economic cycle of boom and bust. Because inflation ensures static money loses value and recessions threaten your active income, doing nothing with your cash is mathematically a losing strategy. To decide who gets to participate in this system, lenders use a 3-digit algorithm called a credit score. It's a measure of your financial trustworthiness. The algorithm looks at your history. Do you pay on time? And how much of your available credit are you actually using? The irony is that you can live frugally and have zero debt, yet still have a terrible score. Lenders have no data to judge your compliance, so you look like a risk. A high credit score doesn't prove you are wealthy. It only proves you are a reliable and profitable participant in the banking system's debt mechanics. Since inflation is quietly stealing your future purchasing power, the only valid defense is investing. Investing is the transition point where you stop trading labor for cash and begin deploying your cash to acquire more of it. You do this by capturing growth, buying slices of companies through stocks, loaning to entities through bonds, or holding property in real estate. Making this engine work requires a specific superpower: patience over decades. Most wealthy people didn't win the lottery. They simply allowed compound growth enough time to mathematically duplicate small, consistent investments into millions of dollars. Once you understand the illusion of currency, the mechanics of interest, and the power of growth, the financial system becomes a tool. You can finally use it to buy back your most finite and valuable asset: your time.